session, and Donal has a dual role today. Donal Whelton, Head of Agri for AIB, is going to give a presentation, but he's also going to chair the session. So first of all, we're going to have Donal give his presentation, and then we'll call up Katie, David and Chris to the podium, and we'll have a panel discussion. So look, again, we're encouraging you to have a good, lively, interactive session. After Donal, the lads will be up on stage, so we'll hope to be plenty of questions thrown at them. So I'll hand you over to Donal.
Thanks, Liz, and thanks very much for the invitation, and to the IGA also for the invitation to speak and chair at this session. Donal Whelton is my name, and I head up the Agri team in AIB, and I'll be joined on the stage later on by Katie O'Toole and David Fogarty, and also Christopher Cahill, to discuss in more detail about their career and their journey to date in their farming career. But I've been asked to set the scene, and maybe set the scene from a banking perspective about where the bank views the dairy sector and how the dairy sector is performing from a banking point of view, and where it is coming into probably a more challenging 2026. Also, I want to talk a little bit, and I've been asked to talk a little bit about how the bank views investment opportunities or financing opportunities, and how a farmer can prepare for investment, and how we look at unsecured finance proposals, secured finance proposals. What are the criteria that we have to adhere to that's laid out to us by central bank guidelines and central bank recommendations. And then also talk a little bit about what a bank would like to see from a dairy business in terms of building resilience in their own operations. So, first and foremost, just looking at some National Farm Survey data and looking at the average dairy family farm income over the last 7 years. And we can see, and as you all well know, the volatility has become much more pronounced, particularly since 2021, where we saw in 2022 the average dairy family farm income was in the region of €160,000 and dropping by over €100,000 in the following year, before we saw recovery in 2024 and further recovery in 2025, albeit we are coming in and looking like we're going to have a more challenging again 2026. And I suppose from a banking point of view, or even from a farmer's point of view, I suppose the message that you'd have to take from this slide is the importance of, and it's linked to what I'll be talking about later on in terms of looking at investment on your farm. It's important not to make any long-term investment decision on your farm based on 1 year's performance because of that volatility, and rather look at the performance of your farm, or if you have it, and some farmers won't, and we'll talk a little bit about track record later on as well. But if you have that track record, to look at the performance of your farm over the previous 3 to 5 to 7 years, if at all possible. Because when you do that and look at this data, the average family farm income over the last 7 years has been in the region of €100,000, albeit there has been swings of over 50,000 above and below that average in a 12-month period. Looking then and making just a couple of comments in relation to where debt levels are on Irish farms and how they have changed over the last 15 to 20 years. And this data here is again central bank data, and it's looking at the total level of debt on Irish farms across all financial institutions, and this is across all farmers, across all subsectors. And we've gone back as far as 2008, because debt levels on Irish farms peaked in Q1 2008 at just over €5.2 billion. And what we've seen since that, and going up to H1 2025, is a continuous pay down and flow back of money to reduce that overall debt levels down to just under €3 billion, or in the region of €2.8 billion, nearly a 50% reduction on debt levels in the last 15 years. And this is just for on-farm investment that farmers have borrowed for. So you're talking about money that's been drawn down for land, building, stock and machinery. And then looking at looking at central bank data and what's happening on the other side of the balance sheet, and what's happening in relation to deposits and cash available in the same time frame, again looking at central bank data, and this is looking at deposits as represented by the primary industry deposits. And in the primary industry, there's a number of subsectors, but agriculture is by and far the largest subsector in the primary industry report that the central bank published, and agriculture is probably contributing at least 85 to 90% of these cash balances. So again, when we look at that, the green line up here, and again a tremendous change in the availability of cash and build-up of cash and resources over that 15-year period. And from a banking point of view, you'll often hear us refer to maybe a loan to deposit ratio, and we look at that from agriculture perspective in Irish agriculture, you can see a complete reversal of the loan to deposit ratio in the last 15 years, where in 2008, 5.2 billion of debt, nearly 3 billion of cash availability, and in 2025, half one figures, we're down at less than 3 billion of debt, and cash availability has grown to over 6.5 billion euros. I suppose one of the other areas that a bank will look at in terms of an early warning indicator if there's any evidence of financial stress building in a particular portfolio, and that's looking at what level of working capital a portfolio of customers are using and eating into. And what we're looking at here is AIB data in relation to our dairy farming portfolio and the level of working capital that they've been using over a particular 12-month period. The red line here represents 2022, and not surprising because of the good output prices in 2022. Throughout the course of 2022, we saw that reduction in overdraft working capital utilisation throughout the course of the year. When we look at then 2023, again, not surprising, it started to increase throughout the course of the year. It peaked in quarter 1, 2024, nearly double that of 2022. But as the second half of the year was improved, we saw the utilisation of dairy farmers on our portfolio using the working capital that was available continue to reduce, and that trend again continued right into 2025, where coming into the 2026 we had the second lowest level of working capital utilisation since we've been tracking records, and I only have data up here going back to 2022. We've been tracking this for many years prior to 2022, and we currently have coming into 2026 the second lowest level of working capital utilisation. So I suppose from a banking point of view, you'd have to say the sector is facing into 2026 in a relatively strong financial position. We have the second lowest level of working capital utilisation since we've been carrying records. We have historic low levels of debt on farm, of which dairy farmers make up a large proportion of it, and we've seen a strong increase in trends in growing deposits and cash availability also in the last 12 months. That being said, and again, I won't focus too much on this slide because Lawrence had touched it in his presentation this morning, but again, to be remiss of the bank not to make some comment in relation to what we're seeing from National Farm Survey data and the increase in total costs on dairy farms. So as I was saying, it would be remiss of a bank not to comment in relation to what we're seeing from National Farm Survey data in relation to the increase in costs on dairy farms over the last 5 years, which has increased by, as mentioned, 46% in that 5-year period, driven by increases in fertiliser costs. We see in 2022 fertiliser costs spiking considerably because, as we all know, the Russian-Ukraine conflict also that has impacted fuel costs and energy costs on dairy farms. We've also noticed an increase in machinery and building depreciation since 2022, and probably again driven by good cash balances available in 2022 and farmers spending money on capital expenditure and buildings, and those assets being depreciated over the following number of years. But also we are seeing, and just mentioned already this morning, this increase in concentrate usage and concentrate costs, where in 2024 the average concentrate cost on Irish dairy farms is nearly 9 cents a litre, and we've seen over the last 5 years that concentrate cost has increased by 56% in that 5-year period. Just want to make a comment in relation to sustainability. As AIB, we have very strong sustainability ambitions, and we have a strong focus in supporting the sector, and particularly the dairy sector, in meeting its emission reduction targets under Ireland's Climate Action Plan, legally binding to 2030. And I suppose from our point of view, when we look at banking the dairy sector and how we can green our loan book by lending to dairy farmers, and the importance of increased grass utilisation by dairy farms, and this very strong correlation between increased grass utilisation and a reduction in emission intensity. As we see from these figures from TAGAS, that grass utilisation increased from 6.5 tonnes up to 8 tonnes. There's a corresponding reduction in emission intensity, more greener production by increasing the grass utilisation in your system. So then, just on the second part of the presentation, I want to make some comments in relation to the agri-banking market and what we're seeing in relation to farmers borrowing money and where they're looking to borrow money, etc. So firstly, asking the question, what is the size of the agri-banking market and how much money do farmers actually borrow down from all financial institutions in any 12-month period? And again, this is central bank data going back to 2015, and it represents all farmers, all subsectors of Irish agriculture and all financial institutions. And we can see that it peaked actually in 2017 at 790 million was the amount of money that farmers borrowed down, again only for on-farm investments, land, building machinery and livestock. And it reduced, the lowest in the last 10 years has been 620 million. And again, because dairy farmers probably feed into this relatively strongly, and the good year in 2022, we saw a reduction in credit appetite, or credit demand, not appetite, credit demand in that 12-month period. But I suppose the point to make is that over the last 10 years, the average amount of money that farmers have been drawing down annually is just nearly 670 million every year. Which, when you look at the previous slide with the level of on-farm debt that now is at its lowest level in 20 years, despite this level of new money being drawn down every year, again it's a very strong indication of how the sector is performing, because the flow back of money and the bank repayments are coming in much faster than this level of drawdown every year as our overall level of debt continues to reduce. And again, over 10 years, we're talking about farmers borrowing nearly 7 billion euros from Irish banks to scale their business and invest in their business. But of course, this doesn't include what farmers have funded themselves out of their own cash flow. And we know, particularly during high milk or output prices, that the farmers do tend to use their own resources to fund capital expenditure projects. Looking at National Farm Survey debt and then relating that average 670 million of drawdown of new money every year by Irish farmers from all financial institutions, what actually is the level of debt on individual subsectors and what's been happening here, again looking at National Farm Survey data. And I suppose the most recent data, I suppose what stood out is that maybe dairy farmers were the only subsector in Irish agriculture where the percentage of farmers with debt actually increased in that 12-month period. So now we have 70% of dairy farmers in the country having some level of debt, and that average debt on those dairy farms is just under 150,000 euros. 147,000 euros having increased from 130,000 euros. But every other subsector in Irish agriculture, the percentage of farmers with debt actually are reduced in that 12-month period. The average debt, however, on an Irish dairy farm equates to approximately 1,500 euros per cow. And then to ask the question, how does that compare with some of our European counterparts, particularly as we face into maybe a difficult 2026, and again looking at debt levels on Irish farms compared to EU average. The EU average is nearly twice the Irish average. When you look at the Germans, it's nearly 3 times. The Germans have 3 times the level of debt on farms than we have. The Dutch 10 times, and the Danes nearly 30 times the average level of debt of Irish farms. So again, you'd have to say, coming into a downturn, that the Irish dairy farmer is in a more competitive financial position because the overall financial cost on a cents per litre will be much lower than our European counterparts. Talking then, and maybe moving to the third part of the presentation, or the second part of the presentation as per the slide, talking a little bit about how the bank views financing proposals and preparing for investment. And firstly, just to maybe highlight that every year AIB engage with Ipsos MRBI to do an independent survey across over 1,100 farmers to get a sense check of farmers' appetite, farmers' demand, farmers' sentiment in relation to their own investment proposals or their own investment decisions on their farm. And when we did this in Q1 of last year, the research told us that nearly 3/4 of farmers that were interviewed, over 1,100 farmers, nearly 3/4 of them were planning to invest on their farm in the next 3 years. The average investment also increased from 52,000 euros up to 62,000 euros, and where farmers were going to be planning to spend their money over the next 3 years, nearly half of them were going to be upgrading existing infrastructure, over 40% upgrading existing equipment and machinery, a third looking to invest in meeting compliance requirements, and a third looking to invest in improving farm safety conditions on their farm. So a couple of comments then I've been asked to give from a banking perspective in relation to starting your career in dairy where you don't have a track record and also where you don't have existing land ownership. And I know we'll be hearing from David and Katie and Christopher about their own career and how they went about this from their own perspective. So from a banking point of view, I suppose first and foremost, where we don't have an existing track record and there's no existing land ownership, and a farmer is interested in starting, the young farmer or any farmer is interested in starting their career in dairy, I suppose the first thing we're looking at is what hands-on experience that the farmer has got. Where have they milked cows? Where have they gained experience? Have they gone abroad? Have they worked in New Zealand? What farmers have they worked with it in the country, and what scale of operations have they gained experience from? During that time frame, when they have been working on those farms and building up their hands-on experience, obviously the next question will be look at what level of savings have they managed to put away to contribute to any investment proposal or any opportunity that they're thinking of undertaking. We're then looking at what is the opportunity that's presenting itself. Is it a share farming, a long-term lease, a partnership opportunity? And then looking at how can AIB support them with unsecured facility because there is no land ownership and there's probably no land or no security available as security, or there's no land available as security. And I'll talk a little bit more detail about this in another slide. So you would be hoping then that the level of unsecured finance that a bank would be able to support the proposal, that combined with the savings that the farmer has themselves, will give them that start and be sufficient to give them that start in the proposal or the opportunity that is presented, whether it's share farming, long-term lease or partnership opportunity. What we'd be hoping to see then over the next 12 or 18 months, that the customer is building their own management track record with the bank, that they are producing a set of accounts that they can say, this is my management experience or my management ability, these are the efficiencies that I'm able to generate. This we'll be able to see how they've operated their own current account, how they're operating their own working capital facilities, and they're building that track record and that experience with the bank. So hopefully after 12 or 18 months or 24 months that they may be able to apply for further unsecured debt. And over that time frame also, then you're also looking at hopefully the farmer being able to build cash resources. Obviously, if they had taken out some unsecured finance to buy livestock, that they're paying that down, so they're effectively growing their equity in the stock, or if not, at least they're growing their equity in the business and they're building their own experience. In terms of then, what are the main considerations that a bank takes into account? And the number one consideration, and I'll talk a little bit about this in more detail also in further slides, is repayment capacity. And repayment capacity is the number one. And there's other considerations that you can see there on the slide that we will take into account. But if we can't get over repayment capacity and satisfy ourselves with the debt service ratio that we need to adhere to, we won't move on to the other considerations. Repayment capacity by and large the biggest and the main consideration that we have to adhere to first and foremost. So then a couple of comments in relation to where a bank will consider and what are the considerations we'll take into account for unsecured finance requests. And again, we're following recommendations and guidelines that are laid down to us by the central bank. The first one of those is that max term for all SME lending, for SMEs and agriculture, a max term is for unsecured finance is 7 years. For farmers or for anybody who has travelled to New Zealand, you might be familiar with a metric the New Zealand Bank uses in relation to interest cover. We have something similar in Ireland, but we have to look at capital and interest cover. What we call that is our debt service cover ratio. And for unsecured finance in AIB, we have to meet a debt service cover ratio of 1.5 times. So what that means in a simple practical example is that if a farmer wanted to borrow 80,000 euros over 7 years with average repayments of 14,300, we need to show free cash flow required of just around 21,500 euros to meet that minimum debt service ratio of 1.5 times. So if repayments are 14,300, we need free cash flow of 21,500 to meet that debt service ratio of 1.5 times. So free cash flow being effectively the cash available after all variable and fixed costs have been paid to run the farm and also all financial costs. such as running your household, drawings, the tax person has to be paid, and also existing repayments before new repayments are factored in. But existing repayments, that's your free cash flow, and it's 1.5 times debt service ratio that we have to meet. Typically, where we don't have a track record, we generally consider requests for less than €100,000. Starting at less than €100,000, because we have no track record, hopefully, as I said earlier, that combined with a customer's own savings will give them enough equity to start their proposal, building their track record over the next 12 or 18 months, 24 months, and then when they have their set of accounts, when they have operated their own bank account, coming back and looking for increased levels of unsecured facilities and increasing their exposure. Question often gets asked in relation to chattel mortgages that are available in other countries and why they aren't available, or why isn't Irish banks taking chattel mortgages. And I'm afraid it's a very easy answer to that, in that there's no legal framework in this country that allows livestock to be taken as security. And what we would need for that to change is that the relevant stakeholders, such as the department, the farming organisations, the ICBF, TAGS, the banks, get together and put a framework in place that's road tested. Very similar to maybe what's going on at the moment in relation to a carbon farming framework that the Department of Agriculture is currently developing to reward farmers for sequestration and increasing biodiversity on their farm. A similar framework will need to be put in place to allow livestock to be taken as security. A couple of comments then in relation to SBCI finance, and we have combined and partnered with the SBCI every year since 2016 to bring products to the marketplace that's available for SME, including agri customers. Our current offering in 2025 is fully subscribed, and we closed for applications in Q4 of last year. That being said, we are in current discussions with the SPCI to hopefully bring another product to the marketplace in late Q1, early Q2, all going well, of this year, that will be available to both SME and agri customers. And again, indicative terms and conditions that hopefully will be finalised over the next number of weeks is that we're proposing max terms of up to 10 years, minimum amount of €25,000, and a maximum secure facilities of up to €500,000. So again, we hope to have those details finalised with the SBCI over the next number of weeks and have that product in the marketplace, hopefully late Q1, early Q2. So that's some considerations in relation to unsecured finance. And then just maybe to reference again, if there is security available, what are the criteria again laid out by central bank requirements and guidelines and recommendations that we have to adhere to. So where there is security available, the first one that we're looking at is loan to value, and what loan will we give to the value of the security being offered. And typically we have to aim for 70% cover in relation to loan to value. So again, a very simple example, if a farmer is requesting €250,000 of a loan, we will require €360,000 of security, which will meet the criteria then of 70% loan to value. In terms of loan to cost, in other words, what percentage equity or input should a farmer ideally be bringing towards a proposal if they're buying land or if they're doing a project on the farm doing capex. Ideally, again, we would like loan to cost of 70%, with the farmer bringing up to 30% equity of their own funds into a proposal. That being said, we will consider up to 100% loan to cost, subject to repayment capacity being met and the minimum debt service cover ratios being met, which I'll refer to later, and also security being offered that will bring our overall loan to value down to that 70%. So for argument's sake, in this scenario, again, look at the previous example, if a farmer wanted to buy 250,000 or wanted to spend €250,000 on land and wanted to borrow the full purchase price of the land, so effectively 100% loan to cost, we can consider that as long as The land that they're buying is offered for security, and additional security is also offered on top of it to bring the overall loan to value down to 70%. And the reason we allow that is that there can be very valid reasons why a farmer doesn't have that 30% to bring towards a proposal, such as they might have used their own funds on doing capital expenditure and funded it out of cash flow, or they might have, and we found in a lot of cases, that farmers build up livestock out of their own resources, and there's a cost of carrying additional livestock, and that's where their money went. So as long as we can be satisfied about why they're not bringing that 30% equity, minimum 30% equity, we can look at that 100% loan to cost, subject to repayment capacity and security thresholds being met. In terms of repayment capacity thresholds, then that has to be met. So we saw on the previous slide, for unsecured finance, we're talking about debt service cover of 1.5 times. Where security is available, we're talking about our recommendations, central bank recommendations, is that we have to meet minimum debt service cover of 1.2 times. So again, effectively 20% over and above the repayments. And then we also have to apply stressed case. So for any new money proposal, we'll do the actual position that we think is going to happen in a normalised year, but we also do a stressed case. And in our stressed case, we have to meet a debt service cover ratio of 1 times. So again, what stresses do we look at and do we apply when we're doing our stress tests? So the first stress test that we do is a business stress test, and that is to cover unforeseen eventualities that may happen, or unforeseen events that potentially could happen in any given year. And we're talking about applying when you're lending 5, 10, 15 or 20-year money. These are events that could happen over the course of the term of the loan, such as a weather event, such as maybe a disease outbreak, TB, the impact of that, such as an injury to the farmer, having to apply labour. These are the sort of the unforeseen events that potentially could happen. And in AIB, how we do that business stress test, we do it by way of 2 cents a litre on the total litres of milk being produced. That's not a milk price stress test, that's a business stress test done by way of cents per litre on the milk. We also applied in a 2% increase in interest rates over the prevailing interest rate that has been negotiated with the customer. And then lastly, we'll also do a nitrate stress test if the derogation isn't continued beyond the 3-year extension that we've currently got. Again, if we're looking at 10 and 15 and 20-year money, what would be the impact if the nitrates went back to, or the derogation wasn't there and went back to 170, what impact that would have on your cash flow. But our base case are based on the 220 we are lending, as the lie of the land today is 220, where our base case is 220. Terms available, we're up to 20 years for land, 15 years for farm buildings and 7 years for livestock. So the last part of the slides is looking at building in your resilience into your own dairy system and what a bank would like to see, and talk a little bit about what buffers and cash reserves hopefully can be built up and be available to support income in a particularly poor year. I also had done a little bit of an exercise on calculating your break-even milk price, but it was dealt in great detail by Lawrence this morning, so I won't go into as much detail on it. Just to make a couple of points from a banking point of view, this is an exercise that our agri team will do with individual customers. And again, you're looking at, as Lauren said this morning, you're looking at what is the minimum milk price that you need to cover all your costs. That's your farm money cost, fixed and variable, but also your financial costs. So in this example, we have 100 cows, 510,000 litres of milk. The farm income, including nearly 36,000 on non-milk sales, was €316,000. Expenditure, variable and fixed costs, 173. So the operating profit or the surplus was €143,000. But out of that, the farmer has to run the household, which was nearly €1,000 a week. The taxman had to be paid, 14, and there was existing financial repayments that had to be met, totaling €85,000. So the surplus, based on the milk price that they achieved in that year, was €58,000. So the minimum milk price that they needed to cover those 173,000 costs and €85,000 in financial costs, all things remaining the same, is you divide your surplus into the litres of milk that you produced in the given year, and you take it off the actual milk price that you received for the year. So this farmer got 55 cents a litre. The surplus divided into the litres of milk was at just over 11 cents. So to cover those costs, this farmer needed a milk price of 43.7 cents a litre. all things remaining equal and no change to the expenditure or to the production system. And then asking the question, what do I actually project milk price is going to be for the next 12 months? And again, this farmer, if he projected that milk price was going to be 40 cents for the next 12 months and made no changes to the farming operation, this customer was going to have a deficit of 19,000 to nearly 20,000 euros. And I suppose the other thing to point out in this example is that every 1 cent a litre above and below the projected milk price was a plus or minus 5,000 euros. So again, if they projected that the milk price was going to be 39 cents a litre for the next 12 months, again, all things being equal, that deficit now is growing to 24 or 25,000 euros. If it was going to be 38 cents a litre, the deficit has grown to 29 to 30,000 euros. So then asking the question, what to do with that deficit? And the first thing, obviously, is to look at the farm expenditure and that 173,000 euros. And is there non-essential expenditure or spending inside in that that can be cut out in a difficult year, such as capital expenditure? Questions that we will be asking: is there cash reserves that can be inputted to cover the shortfall? And is there possibly availability to build up some creditor debt also? Obviously, it's a year to focus on costs. Is there an opportunity now focusing on costs? We've heard in every session this morning about the cost creep that has come in over the last 4 or 5 years, and this is an opportunity to adjust and refix that cost creep and look at where you are offside and how you can go about fixing it. From a banking point of view, what are the options that are available? If you do need bank support, we're very much of the view that there's no one solution will suit every farmer, so that we have a range of options, and it can be one of these options or it can be a combination of these options that the bank will offer you if you do require that support. These can range from working capital, increasing the overdraft, looking at the term loans. We will find, and what we did find back in 2023, when customers did need cash flow support following that drop in milk price in 2023, a lot of farmers had used their own money to fund capital expenditure in 2022 and did it out of their own resources. So we can look at retrospectively funding that amount of money that you spent out of your own funds and putting that cash back into your system again. So for example, if you would spend 20 or 30,000 on a calf house or on the silage lab or whatever, we can put that 20 or 30,000 euros back into your current account and term it out over an appropriate term. The last point, I suppose, is that we all know on this slide, the last point is that we all know that 2025 was a relatively good year profitability-wise. So again, we will have tax liabilities to be paid on that at some stage in 2026. So again, the message from a financial institution is go away and prepare your 2025 accounts as early as possible and identify what potential tax liability you will be facing throughout the course of 2026 and plan accordingly for it. So again, practical examples of resilience and what a bank would like to see dairy farmers try to create on their farm. And again, it's a question that's often asked us, how much of a buffer fund that a farmer should have based in relation to covering their repayments, but also in relation to working capital that should be available to them. And in relation to covering their repayments, I suppose for us as a financial institution where we have, I suppose, any farmer with borrowings greater than 3,000 euros a cow, we would always like to see that a farmer has at least 12 months repayments put aside to cover those repayments in a particularly poor year, so that there's no financial draw off the farm to cover repayments when milk price is poor. In terms of working capital, what should be available? Again, we would like to see at least 500 euros a cow being available at the start of the year in terms of working capital, be that from your own resources, be that from working capital facilities, or indeed it could be beef stock that's on the farm or non-milk sales that are not on the farm that could be or will be sold. And as it's been alluded to already, we have seen that increase in the value of livestock on dairy farms now worth maybe between 5 to 10 cents a litre. One thing that I suppose, and just a comment, and it's becoming more commonplace and we're seeing it a little bit more often because farmers by their nature, they want to repay debt down quickly, and we are finding scenarios where farmers can have relatively low levels of debt, but all that debt is over a relatively short period of time and have too much repayments over a short period. So their overall debt level or debt per cow can be relatively modest, but all that debt is over a short period of time. And again, when you have difficult year like 2026 or like 2023, it can put pressure on cash flow having too much short-term debt. So again, the message here is try to structure debt over an appropriate term. And again, just using a crude example of the difference of paying back €200,000. If you borrowed over 5 years, the repayments are nearly €4,000 a month. Over 15 years, it's €1,700 a month. So in a 12-month period, the difference in repayments is nearly 28,000 in cash flow in meeting a repayment over 5 years on 200 grand versus 15 years. And as I say, if that's a variable rate loan and you have a particularly good year again, you can always make out of course repayments at no penalty and pay it down ahead of schedule over when times allow. But again, the importance of having debt structured appropriately and not having too much short-term debt if at all possible. So before I call David and Katie and Christopher to the stage and hear their journey and their career to date in farming, I suppose just to summarise from a banking point of view, overall you have to say the sector is in a relatively good position. We have seen the debt levels on farm reduce over the last 15 to 20 years to currently the lowest level of debt on farms. You correspond that with the other side of the balance sheet and the increase in cash availability and resources that have been built up over the same time frame. And we're also facing into 2026 with historic low levels of working capital utilisation. So coming into the year in a relatively strong, coming into 2026 in a relatively strong financial position. That being said, from National Survey data, we have seen that cost creep, particularly over the last 4 to 5 years, and is 2026 a year that try to identify if you're offside and why you're offside in any particular cost. If bank support is required throughout 2006, what we would like to see is that you try to identify the level of support that is required. And I suppose from our point of view, that will allow us to put the right amount of support in place for your business and put it in place at the first time of asking and get it right first time because the dairy sector, the agri sector has been very, very good to AIB and we're committed to supporting the sustainable long-term development of the sector. My last comment is that, and we saw it in 2023, it can be a difficult year. Pressure can build quickly, particularly during low milk prices or where margins are tight. And just remember to look after yourself, look after your family. You're not alone, and probably, I suppose the message is focus on things that's within your own control, such as grass utilisation and cost control. So I'll leave it at that, and I'll invite David and Katie and Christopher to the stage. And while they're coming to the stage, if there's any questions.
Just the 70% loan to value that the bank looks for security. Where does that figure come from? And is it the same for every industry? It just say for a loan up there for a loan of 250,000 or needing 360 worth of security, it doesn't seem like the bank is taking on much risk at all. In that situation, you can always shift the land if the loan ever falls through.
Yeah. Well, the first thing I would say is that the bank will never make a lending decision based on the security that's being offered. You can offer all the security in the world, but it's no good to you unless we can meet the repayment capacity metrics that I outlined. So it's one of the last considerations that we will take into account is the security being offered and the value of security. So repayment capacity consideration is the first and foremost. But that's 70%. It's the same for all SME lending, including agriculture. And again, it's guidelines laid down or given to us by the central bank and included in our banking licence.